Paula, enough from me. If you'd like to take control of the screen and put your slides up, we look forward to hearing from you, and thank you again for taking part.
Thank you. Hopefully everyone can see my screen now, and you can see it all absolutely brilliant. And yes, my focus is very much on owner-managed businesses, and I love working with owner-managed businesses because I find them very different to your very regimented corporate, because one of the things in dealing with families and tax is I find the lines are always blurred. What's the company's is theirs and what's theirs is the company. And as a tax advisor, it can be very challenging because clients struggle to see the difference between spending it out of their own pocket or spending it out of the company bank account. And it's only you as the advisors, when you try to sort out the mess at the end of the year, that you have to go through all of this with them. So what I've done today, I've gone through, and those of you who've heard me before will know that I love doing sort of a pick and mix of topics. So if I've got a few topics, then there's points of interest that are coming up. So the 6 things I've chosen to talk about tonight: financing the business. Do you go down the route of loans or capital? And then I'm going to have a look at tax efficient profit extraction, moving on then to look at dividends and salary waivers, particularly important at the moment. And moving on then to look at company transactions between connected parties. Then I'm going to just highlight some of the issues to address in succession planning, because in smaller businesses, sometimes succession planning isn't addressed until it's too late. And then last of all, I thought, well, do you know what? I'm going to wrap up with the TAR, because for anyone who's been looking at company liquidations and wondering whether or not capital treatment is available, then there's loads of interesting things to talk about in the TAR. And as Jonathan said, look, I'm perfectly happy to take questions as we go through. So if you've got questions, I've said to Jonathan, if they look like they're related to what I'm talking about, great, send them through. If you're asking me a question about something I'm not even talking about, well, that's something I can always come to later for you. Now, we're going to have a couple of poll questions tonight, because I think that sort of breaks it up a bit for all of us. So the first poll question we're going to have is in relation to financing the family business. So on this particular one, you have a client and your client has asked you to advise on putting money into his son's trading company. So his son said, hey, Dad, can I have £50,000? And your client's phoned you up and goes, I need to put the money in quickly. How do I put the money in? Do I put it in as share capital? Do I put it in as loans? Or does it depend? I'd like to hear your views. Oh, interesting coming up. Now, one of the options hasn't got any votes yet. They're all perfectly valid options. So, yeah, are we almost there? I think. Right, okay, I think we'll end the poll there. Well, interestingly, nobody said to put it in as share capital. You all thought that was such a disastrous idea. Definitely don't do that. 34% of you said, well, put it in as a loan, and 66% probably the right answer. It depends. Well, let's go on and have a look at that now. So, well, it could go in as loans, or it could go in as equity, or it could go in as a mix of both. And I'm just trying to get rid of that polling screen. Yeah. So the key considerations that you want to think about is when money is going into a business, the first thing you want to think about is, well, let's assume it all goes wrong. I'm a pessimist. It's all going to go wrong. How am I going to get my money back? And if I don't get my money back, how am I going to get tax relief for the money I've put in? So that's going to be a fundamental thing that I'm going to look at. And then I'm going to look at, well, my optimistic side, what if the business is successful? How am I going to get that money back out again? Is it going to be easy for me to get my hands on the money when I see the profitable company? And also, if there are other shareholders involved or other individuals putting loan into the business, how am I going to keep parity with them so they don't take over the rights I already have? Well, the first thing I want to look at is, if you look at putting a loan into a business, well, if you have a qualifying loan, you can get tax relief where you borrow money from a bank and then you lend that money on to a closed trading company, and you can get interest relief for that. That works quite well. You might be able to go in and under the seed EIS rules, which means that you can invest some money, and you know, by investing money, you'd invest it into share capital, but the sale of that share capital, when there's ultimate success with the business, would be tax-free. So that could be quite worthwhile, tax-efficient gain. If you want to look at how do you get your money back out when the company has sufficient cash, well, if you put a loan in, a loan is really easy to get back out. You can just call your loan back down again when the company has sufficient cash. If you put your money in as share capital, it's very difficult to get your money back. So what are the routes available to you? You could look at going down a reduction of share capital. HMRC don't like that at the moment. So it might be very hard to get clearance. And if you don't get the right clearance to take out that capital you've put into the business, then you're going to end up with an income tax hit. So it's going to be charged as if it was a dividend. But the first thing I'm going to look at is in relation to the loans. And as I said, I'm a pessimist. So I'm assuming it's all going to go wrong. So what I want to know is, if I put my money in as a loan and that loan becomes irrecoverable, am I going to get any tax relief? Well, the good news is you do get tax relief, because under the Capital Gains Tax Act, Section 253, there is a relief for loans to traders. So that's where you've made a qualifying loan to a company and the money is used by the company for the purposes of its trade, and the person who borrowed the money is UK resident. And the only requirement to get a capital loss in relation to an irrecoverable loan is that the amount has become irrecoverable. And if the amount has become irrecoverable and it hasn't been assigned, so you haven't assigned the benefit of the loan to anyone, then you'll be able to claim a capital loss. Now, that might seem very straightforward, but there's a load of pitfalls. Because, as I said, the key thing is that the loan has become irrecoverable. So if the loan is made at a time that it's never going to be recovered, then it didn't become irrecoverable. It was irrecoverable from the outset. If you've taken steps to make the loan irrecoverable, then maybe waiving the loan before it was irrecoverable, then you'd also lose the benefit of that tax relief. But the good news is, if you've got guarantee, so if you've got somebody who's called on to pay an amount and under a guarantee, then of course your guarantee, when you put the money in, it's never recoverable because it's been called in and under guarantee. So if it's called under a guarantee, you'll get your capital loss anyway. So that's good news if you have if you've made a loan to a trading company and you're not able to get your money back, you might have the benefit of capital loss, and you can make a claim for that capital loss. You can go back up to 2 years, provided the loan was irrecoverable within that 2-year period. So you can go back. The downside of this is, how many of your clients are flush with capital gains? Well, I can tell you not many of my clients are flush with capital gains. So they say it's great to have a capital loss, but can you not do any better than that? And I suppose that's where we look at, well, should the money have gone in as share capital? So if you thought there was a risk that this money would become irrecoverable, well, maybe you should have looked at investing it in as share capital. So if you have shares in a company and those shares become of negligible value or you sell them at a loss, the starting point is you've got a capital loss, and that capital loss can only be offset against your capital gains. But there is a special rule, and that's the share loss relief rules. And what these rules say is that, well, if you've invested into certain kinds of companies, then you might be able to take that capital loss and you might be able to convert that capital loss into an income loss. Now, that's far more valuable, and my clients much prefer that kind of a loss. So then you have an income loss that you can set against your income for the year, and you're more likely to get benefit from that loss. And that loss is subject to the cap on income tax relief. So it's the greater of 50,000 and 25% of the adjusted total income. So how straightforward is it to get that loss? Well, you might think, if I have shares in an unquoted trading company, well, that should be enough, surely. Well, it doesn't work like that. And the rules are quite complex. And I have got a nicely designed flow chart, which I can send to you afterwards. But the gist of what you're looking at is, first of all, was EIS relief attributable to the shares? Now, if you tick yes to that box, you're laughing, you're home and dry, because your loss, you're automatically going to get that share loss relief once you put in your claim. You don't need to prove anything else. If you didn't get EIS relief on those shares, then the next thing you have to look at is, did the shareholders subscribe for the shares? So that means they subscribe directly to the company to get those shares. And if that's yes, you can still keep looking at this. If it's no, and they bought the shares secondhand, tough luck, you're out. You can't convert your loss into an income loss. So once you've found out you've subscribed for your shares, then you need to go down and look at a number of conditions. And I can't circulate these to you afterwards, but the main conditions you're looking at is that, do you have a trading company? And those trades must be very similar or the same as the EIS trade. So you're not going to get anything for like property dealing companies, property development companies, or something that's quite heavily asset backed. Then you're looking at was the company an independent company, i.e. it wasn't controlled by another company? And were all of its subsidiaries qualifying subsidiaries, i.e. did those subsidiaries carry on the same kind of trade? And if you can tick yes to that one, then you move on to the next test. And then the next test looks at, well, was it that kind of a trading company throughout the last 6 years, or if the company's younger than 6 years since its period of incorporation? And if you go yes to that, then you're on to nearly at the last test. Now, the last test is more difficult because this test is the gross asset test. And this is the test a lot of people forget about. And there have been numerous first-tier tribunal decisions or cases on this, and I don't know why they were taken, because they clearly didn't meet the gross assets test. But the gross assets test is that the company had gross assets not exceeding 7 million immediately before the shares were issued and 8 million immediately after the shares were issued. So that's quite a low amount. So it's watching out for those thresholds. And I say they're low amounts, but it does actually depend on the company. And then if you pass that test and you passed your gross asset test, the next thing is, well, was the company wholly or mainly trading in the UK? And if it was, then relief should be available in under these share loss rules. So it is worth going down to that. I think one of the mistakes and the common errors in relation to this claim is people go, oh, it's an unquoted trading company, therefore you will get this share loss relief. But you need to work your way down through these steps. And as I say, if you have EIS relief, that's perfect. So going back to the question I asked at the start, does your client put their money in as capital? Do they put the money in as loans, or are we still thinking it depends? Well, I would be asking questions like, what is the son's business all about? Does the son have a good track record in this kind of a business? And if the son is successful in this business, is the father to participate in their success? And if he is going to participate in this success, then they should look at having some form of share capital. If your client's very precious about getting the money back and wants it structured as a loan and wants to take the risk of perhaps a capital loss, then you'd go down the loan route. But it's not an easy question. And I do see on the share loss relief, you need to have subscribed for the shares. So one of the things you need to be careful of is that the money doesn't go in as a loan and then it's converted into equity, because there is a risk that the shares aren't properly issued or subscribed for. And there's also a risk that the loan was a lower value at the time of the conversion, which means then you'd lose out on the value of the shares as well, because they would convert at the value of the loan. But it's always something that you need to look at carefully. And of course, the client phones up and goes, it's a quick question. Yes, it's a quick question, but no, it's not a quick answer. Moving on now to look at the profit extraction strategies. I just wanted to run through quickly the kind of things you can do in relation to profit extraction. And I'm not going to do any calculations in relation to dividends and salaries and which is the most efficient. But I think that most people know at this stage that a dividend tends to be the most tax efficient route of taking money out of a company if you are looking at it just purely on cash terms and what net cash is going to come out of a business. But the differences between them for higher rate and additional rate taxpayers is 0.5% or something. So it's not a huge amount. So I think there are other things that need to be talked about when you are looking at profit extraction. So if you're looking at somebody who's going to need some pension, or they're going to need some national insurance contributions, that should be factored into it. If you're looking at something, the company getting a tax deduction for any payments that it makes, then you're looking at going down the salary or the bonus route. And you're also looking at the types of shareholders you have. So if you've got a wide base of shareholders within the family and they all have shares in the company, then it may be that there's dividends paid out up to a certain amount. And for those who work in the business, then they would either have a different class of share, which we'll come on to in a moment when we look at dividend waivers, or they would be remunerated through salary and bonuses. The other common way, of course, is benefits in kind. So it's just looking at all those kind of tax exempt benefits like the mobile phone that you can have, or looking at whether it's worth putting cars through the company. And, you know, I'm going to just share something very small with you on the Australian tax system, because I've been doing some work on the Australian side, and interesting, they do benefits in kind in a much better way. The formulas for working out the benefit in a company car is just so straightforward, but it's all fringe benefits. So what happens is if there are any benefits provided to employees, then the employer at the end of the year totals up the benefits, multiplies it by a rate of tax and pays that tax over to the Australian tax office. So the individual who receives the benefit doesn't get any tax charge on any of those benefits. It's all picked up by the company. And it's just so much easier to deal with. So they don't worry about things like coding notices and getting the right amount. So yeah, it might be something that in time in the UK, they might look at revamping the benefit system. The other way of getting money out of a company is in relation to sort of exits. So you're looking at capital exits. Now, going back the last 10 years, the difficulty in taking money out as capital is it's getting harder and harder to do this. And in particular with everyone trying to access the capital gains tax rates. So the only real capital opportunities you get are on retirement, or you have a shareholder who's exiting the business. And you can either then look at purchase of own shares if the shares have been held for 5 years, and you can demonstrate that the repurchase of shares is going to benefit the trade. And of course, making sure that you've got the right set of circumstances, that the individual is not going to remain connected with the company, they're going to substantially reduce their interest in the company, and that you have the necessary reserves to do the buyout. And if you've got a circumstance where somebody's retiring from the business and you can meet the other tests for the purchase of own shares, then HMRC will approve it on the basis an individual is retiring, because they see that retirement as a benefit to the trade. If the individual is not retiring, it's harder to argue the benefit to the trade. So you're normally looking at where you have a shareholder who's perhaps been disruptive, doesn't want to pull along with the new ways of the company, or you have somebody who just wants to go on and do something different. So if you can't go down the route of doing a purchase of own shares, then the other kind of thing you'd look at doing is what they call the management buyout structure. And it sounds a lot more complex than it is, but basically it's you set up a new holding company for all the shareholders that wish to remain in the business. And that company makes an offer to acquire the existing company. Everyone who's staying in the business takes shares in the new company, and everyone who wants to exit takes capital. And that way then you have shareholders exiting the business with the other shareholders remaining in, but you're able to get a capital transaction. And that is something you would need to go to HMRC for clearance on, because while you'll be able to demonstrate the commercialities of these exiting, you just want comfort that HMRC are not going to issue any kind of a counteraction notice to tax the amounts received as capital as if they were a dividend. So that's the kind of thing you'd be looking at there. The next way of taking money out, of course, interest on the loans we just talked about. So if you've money you've put into the business, then to charge an interest rate. And if that interest isn't paid within 12 months of the end of the accounting period, then you won't be able to get a corporation tax deduction for that, because the individual is only taxed on a receipts basis. And then rent as well. Rent's a good way of getting money out of the business. Now, given the changes to business asset disposal relief stroke entrepreneurs relief, a lot of people didn't charge rent where they had commercial properties which were used by the companies. And one of the reasons they didn't charge rent was they were worried about losing their entrepreneurs relief. Now that the limits have come down to 1 million, well, it might be worth revisiting and seeing if it's worth charging rent at this stage. Because if the value of the business itself already takes you to the threshold for business asset disposal relief, then there's no need for that property not to have any rent charged on it. So it's worth looking at that. And remember, for BPR purposes, so business property relief, you don't worry about charging rent. You still get your 50% IHT relief on that. So it's worth revisiting those. So that was just a quick whistle-stop tour of the profit extraction strategies.
Paula, can I just interject, because I've got a couple of comments and questions,
okay,
if that's all right. First one sort of starts off as a comment. Tax options would be another route, wouldn't they? But does this qualify for EIS? Then the same person sort of mentioned the dividends allowance is now 2k per annum, isn't it?
Oh,
5k allowance. Yeah, sorry, no worries. The third question is, when you would do a management buyout, the partner that is retiring, would they be eligible to claim entrepreneurs relief?
I'll answer your third question first because it's fresh in my mind. Yes, they would, on the basis that they would have a capital transaction. So if they would have got entrepreneurs relief or business asset disposal relief as it is now, then they would still be eligible for that. The key to it is getting the capital transaction. The first question I didn't follow.
Right. Okay. Well, if the gentleman who's posed that wants to sort of just expand upon that, what I've got is tax options would be another route, wouldn't they? But does this qualify for EIS? Maybe we'll move on and
we'll come back to that one. I'm happy to take that at the end and go through it.
Brilliant. Thank you. Thank you.
Okay, no problem. Right, moving on now to have a look at dividend waivers. Now, dividend waivers is something that's been happening a lot in the past 6 to 12 months, and salary waivers as well. So it's looking at, well, first of all, what is a dividend waiver? It's giving up your right to a dividend while the other shareholders take their dividend. And the key thing for doing a dividend waiver is to make sure that it's done in advance of the dividend being declared. So you can't waive it after the dividend has been declared. And this is where it becomes important, whether it was an interim dividend or a final dividend. So with an interim dividend, it's just paid. So the waiver must be before that payment date. And if it's a final dividend, well, that's generally voted on at the general meeting. So it needs to be waived before it's voted on at that general meeting. And any period of waiver needs to be for less than 12 months. So waiving not more than 12 months worth of dividends if it's not to constitute a transfer of value for inheritance tax purposes. But the things you want to watch out for is employment-related securities. So the specific rules within the employment-related securities rules that say if value passes into shares, which is owned by employees in the company, and in most cases shares are now employment-related, it's just so broad. But if value passes into those shares, then that would trigger a charge under the employment-related securities rules. So by putting more dividends into shares, what that can do is increase the value of those shares. And HMRC have something within the legislation to catch that. So it's watching out for that. And it's making sure that the employees and directors are still getting sensible salaries within the business. So they're not being poorly paid by dividends. And I suppose this all goes back on the back of the PA Holdings case, because in that particular case, the employees received a lot of money as dividends because the company was trying to avoid national insurance. So now what HMRC are looking at is making sure the employees and directors have got reasonable salary amounts. But the one you want to watch out for is in relation to the husband and wives and civil partners, so the spouses or minor children, because in those particular cases, dividend waivers can amount to a settlement. And if they do amount to a settlement, what that means is that the person who has waived the right to a dividend, well, that person remains taxable on that dividend, even though that dividend has now been paid to somebody else. So what you're looking at is, look at the retained profits in the company. If shareholders waive the right to a dividend, would everyone still get the same dividends, or are they going to use up all of those retained profits? If they are, then HMRC would argue that the dividend waiver was done to benefit the other shareholders. so they could look to tax it on the individual. Even if the profits would have been enough to cover that level of dividend to the shareholders, had everyone taken the dividend, HMRC would then look back and say, well, have there been successive dividend waivers over the previous few years? And if there have been successive dividend waivers, then they would seek to tax those on the individuals again. And I suppose the key or most recent case we have on it's probably about 10 years old now, but that's the Donovan case, Donovan and McLaren. And what they did, they basically, the husbands in the company, there was 2 husband and wife couples, and the husbands waived their right to a dividends. So the wives got the dividends. The wives were basic rate taxpayers, so there was a substantial amount of tax saved over a number of years. So HMRC looked at this. They challenged it. They said the settlements legislation applied, so the amounts remained taxable on the husbands. They disagreed. They ended up in the first-tier tribunal. The first-tier tribunal agreed with HMRC and said, well, actually, they couldn't see any commercial reason for doing what they did. The husbands did put forward an argument they wanted to retain money in the business for future investments into tools and equipment, but they couldn't substantiate that. And also, because the amount the wives got as dividends actually meant that there was nothing really retained in the company. So it's just watching out for the settlements legislation. The same will apply if you waive in favor of a minor child as well. And that can be quite tricky, because if you have a situation where you give your child shares in a company, then any income your child gets on those shares would be taxable on you in any case if it's over £100 a year, because that would be within the settlements rule. What we're seeing a lot of is grandparents now subscribing for shares in a company. They're then gifting those shares, and in gifting those shares, then there's subsequent dividend rights. So if there's waivers then done in favor of those shares, even though the parents didn't give the shares, it was the grandparents, they could still be caught under the settlements legislation to the extent that there are dividend waivers. Now, when we're on the subject of dividends, I just want to very quickly talk about illegal dividends. And illegal dividends happen on a very regular basis. And I don't think anyone sets out deliberately to do an illegal dividend. It's something that happens over a period of time because somebody takes the money out of the company a couple of months and without actually doing the accounts and everything. But if you've got an illegal dividend, well, the dividend is potentially repayable to the company. But HMRC would also seek to tax that dividend. But because it's an illegal dividend, they would either seek to tax it as salary, on which PAYE and national insurance would be due, or you would argue, no, it's just an advance, it's a loan from the company, in which case you'd be subject to the Section 455 charge, as well as a benefit in kind charge. So just watch out for those. And just lastly on this, to look at remuneration waivers. So we've seen quite a lot of these during COVID. So if you waive a salary after the entitlement has arisen, then the donor or the employee who's waived it is still liable to tax and national insurance on the amount waived. It's still going to be a valid gift of a net amount to whoever they've given that to. And if they've given it back to the company, it's a gift back into the company. But it would be a gift of the net amount. So the key thing again is to execute the waiver before the entitlement to the salary or bonus has arisen. And also, and the same for dividend waivers, make sure it's executed as a deed. Because you've got no consideration, these have to be executed as a deed. So very quickly now, I want to have a look at connected company transactions. And this is something I've seen just over the last few months. There's been a couple of cases which have come to light. Now, I have got a poll question here on this one as well. So this poll question looks at, it's a question, it talks about transfer pricing rules, but it's not really in relation to transfer pricing rules. But if the transfer pricing rules for connected companies do not apply, the paying company will always get a tax deduction provided the receiving company pays tax on the income. True or false? Oh, I thought I had 100% true there for a moment. No, it's good mixed answers coming up. Oh, it's pretty neck on neck at the moment here. We're 50-50. I'm not sure which one's going to swing it. Right, I think we've concluded now. So, oh no, it's moving again. Right, okay, so what we've got is 48% said it's true, 52% said it was false. Well, is it true or is it false? Well, it's false, because this is something that it's coming up through the tribunals quite a lot. There is no such thing as tax symmetry. So just because you're not within the transfer pricing rules does not mean that companies can transact with each other at any value. That's a myth. And the idea of tax symmetry is a myth. Just because one company gets a deduction doesn't mean another company be taxable, and vice versa. So the kind of thing you want to watch out for is if you have transactions between connected company, in particular where they're providing some kind of service, then the risk is that the company who's providing the service and charges the fee, they'll be taxed on the full amount. It's very seldom the revenue wouldn't seek to tax them on the full amount. However, the company who's paying for that service, the revenue might argue, well, it's not wholly and exclusively for the purposes of the business. Maybe they're trying to do a favor for this connected company. And if that is the case, then you won't get a full deduction and under the wholly and exclusively rules. But the difficulty is the company who's received the income is going to be fully taxed on the income. And it's just watching out for those kind of situations, because it is very easy to think if you're not within transfer pricing rules, well, actually, it doesn't matter what values you transact at. HMRC will never tell you you've overcharged someone for a service. They'll always tax you on the full amount. However, for the person taking the deduction, HMRC will be looking to see, is that some kind of an arm's length price? So just watching out for those kind of transactions. But I wanted that to nicely lead me into something that I get a lot of queries on, which is in relation to connected party loans. So this is where you have two companies who are owned by the same shareholders. One lends money to another, and then they write the loans off. And you'll have seen this a lot, and you'll have had a lot of questions on it. But here you're looking at, well, if you've got trading debits and credits, so this is where the loans have gone in and they're being used for the purposes of the trade, well, the rules in relation to loan relationships override those wholly and exclusively rules that we've just talked about. So therefore, in this case, you should get the tax symmetry, because where you have these connected party loans, where it's one the company writes it off, then the company who writes it off will not be entitled to a tax deduction, but the company who benefits from the write-off is not taxable on that amount that's written off. So it's made a gain on a loan relationship, but it's not taxable on it. So where you tend to see this is where maybe you've got a successful trading company and the shareholders set up a property company on the side, and the trading company lends money across. And by lending the money across, it may or may not get a repayment, but it may decide at some stage to write off the loan. And if the loans are written off, then you get tax symmetry in that no one gets a deduction and no one is taxed on the income. So that's worth having a look at if you're trying to tidy up some accounts. But just, you know, it's one of these things that it works nice if you've got the right set of circumstances. However, if you habitually lend money to a company with the purpose of writing off that money, then HMRC will look at it and they'll argue that it wasn't within the loan relationships to start with.
Paula, can I come in again, if that's all right? Sorry. I've got a point or a question. Are you suggesting then that if there are related party transactions, they should be justified at the time of invoice?
Yes.
Perhaps hours worked or similar?
Yeah, exactly that, because then you've got everything justified from the outset. And it's something I've seen the revenue look at over the last few years, which they hadn't looked at previously. So people always assumed if you're not within transfer pricing, then you're okay, because one company's paying tax, the other getting deduction. That's not how the revenue work.
Okay, thank you. Thank you.
All right, the next connected party loan I wanted to look at is where a shareholder lends money to a company. And this is where it gets a bit more difficulty, because if you've got company lending to company, we're all within the loan relationship rules. Once you put an individual into the equation, then you're not within the loan relationship rules as an individual. So the first thing to look for if you lend money to a company is that interest deduction. So if the interest isn't paid, you may not get a deduction in the company. If the shareholder then writes off the loan to the company, then that loan write-off is taxable in the company because the company has made a profit on that loan. So that immediately is taxable. The shareholder, however, is not necessarily going to get tax relief. So if it writes off the loan, you need to look and see, well, could you make a claim in under Section 253? And that's what we talked about at the beginning. And in order to make a claim in under Section 253, the loan has to become irrecoverable. So if you've just written it off and it hasn't become irrecoverable, then there's no tax relief for that. So it is getting the situation right where you have a shareholder writing off a loan to a company. I'd normally suggest you don't write off a loan to a company. And if you have a loan in a company, as I said earlier, if you have a loan in a company and you think it's not going to be recoverable at a later date, but before it becomes irrecoverable, if you can convert that into share capital, at least then you can have shares in the company. And then if they become of negligible value, you can make your capital loss claim, and then you can go on and make your income claim as well. So then it can sort of come together quite nicely. But just watch out for that sort of shareholders lending into a company and trying to write it off. Now, the other thing I want to talk about, I wanted to do something on succession planning. And then the last bit I wanted to wrap up on was in relation to the targeted anti-avoidance rule. But succession planning, it's more than just tax. And I think one of the things for owner-managed business is they get very fixated on the taxation side of things and how it's going to work. And, you know, is there going to be gift relief? Is it going to cost me when I gift it to someone? What's going to happen when I die? And is there going to be BPR? But the time to start talking and thinking about succession is in the very early days of a business and throughout the life of a business. And the kinds of things you need to be sitting down with your clients and saying is, well, who are the key stakeholders in the business? So you're probably going to have family members. Some will work in the business, some won't. The ones who work in the business will feel disgruntled because the people who don't work in the business have shares and get dividends. Then you're going to have the ones who work harder in the business and feel that they're underpaid. They don't get the same salary as a third party who works in the business. So it's looking at how you deal with those in relation to getting their package right. But it's understanding the needs then of the exiting shareholders and mom and dad who want to pass over the business. Well, what's going to happen when they pass over the business? Do they still need an income from the business? Do they still want to have a stake in the business? Or are there any children who even want to take the business forward? So there are all those kind of things that you need to talk about before you ever start about giving away the shares or gifting the shares or getting that succession plan in place. So the key things you want to look at, is it the plan that the business passes on death, or is it the plan that the business passes during lifetime? And depending on what the plan is, then your strategy is going to be very different. So for example, if you're going to pass, or if you're looking to pass on death, then the key thing is going to be getting business property relief. So you want to make sure that on death, the business goes to the children or whoever with the benefit of business property relief. And if it's looking like you have business property relief now, but you're not going to have it at a later date, then one of the things is, well, is there an opportunity during lifetime to make a lifetime gift to preserve that business property relief? Now, there's a quirk with business property relief, because if you gift something to somebody, then you normally have to survive 7 years to take you outside the inheritance tax net. And gifting shares in a company is no different. So if you gift shares to someone and you don't survive 7 years, then that gift comes back into your estate, and the rate of tax will depend on how long you survived after the gift. But if the shares qualified for business property relief at the time you made the gift, then provided the individual still hold the shares should you die within 7 years, it doesn't matter if the company qualifies for business property relief. And that's probably best explained using an example. So let's say I have a trading company today, a very successful trading company. It does plant and machinery hire, and it's got this fantastic, huge premises. We know it qualifies for business property relief. However, what we also know is that somebody would like to rent the property from them, and it actually pays more for them to rent the property to a third party than to continue to run this business. So they're seriously thinking about this. But once they start to rent the property, then the company will no longer qualify for business property relief because it will become an investment company with rental income. So in that kind of situation, I'd be talking to them about making gifts of shares now at a time when the shares qualify for business property relief. And then should they not survive 7 years, provided the children or whoever received the shares still holds the shares at date of death, then there won't be any inheritance tax. And all you have to do is hold the shares, even if the company has now become an investment company. So it is worth thinking about gifting during a lifetime. And I've put a slide there on just gifts and the benefits of gifting during a lifetime. So, you know, benefit I've just said is to preserve your BPR. Of course, the downside is you lose your capital gains tax uplift that you would have got on death because the shares actually go across at their capital gains tax base cost because you would be using gift relief. And of course, if you can't get gift relief, but you can get BPR, then one of the things you can do is look at transferring it into a trust and then availing of the relief. But it's just looking at where is the business going to go forward. And now my slides there have very much focused on the family side of things. In some cases, it will be the employees who will be taking the business forward. And if you have employees taking the business forward, then you need to start looking at share schemes and getting equity into that senior management team. Now, the last thing I wanted to wrap up with, and it's probably the most meaty topic, is in relation to the targeted anti-avoidance rule. And I have got another question for you here. So this is another poll question, and I promise you it's your last one, but I think it's my favorite one. So in this particular question then, in applying the targeted anti-avoidance rule for your clients, I've got 3 options. I'm just waiting for them to show up on screen. Yeah. So applying the targeted anti-avoidance rule for your clients. 1, you are clear when the rules apply. 2, what's the tar? Or 3, I struggle to come to any conclusion or a decision. Oh, the answers are going fairly equally between the 3 of them. Right, I think are we almost there? Oh, is people still voting now? Yeah, I think we're there on the votes. Right, okay. Well, 15% of you are really clear when the rules apply. I think you need to come and give this lecture because I'm not still very clear on when these rules apply. 44% have said, what's the tar? Yeah. And 41% said, I struggle to come to a decision. And you know what? You won't be alone on that. So let's go and have a look at the tar. The queries come through on the tar and people are very confused. So one of the confusions is that the tar prevents you having entrepreneurs relief or business asset disposal relief. That's not what it does. What it does is it prevents you having a capital gain, which is far worse because anything you have would be taxed as income. But there's a number of different tests in relation to this. But the gateway is the first thing you have to have is you have to have a winding up. So the company is or has been a close company within the previous 2 years, and the individual that you're looking at in relation to the individual who had the receipt has had a 5% shareholding and at least 5% of votes in the company. So you've had a winding up with a closed company. And if you've had those 2 things, then the next thing you need to see is, well, if you don't have a trigger, then you should be able to have your capital gain, subject to anything in relation to transactions in securities. But using this gateway, if you don't go any further, you've had a winding up, you've had your capital, you've walked away, then you shouldn't be caught by this. So then the trigger is looking at as well, within a 2-year period from the distribution, is the individual carrying on a same or similar trade? And that's where it gets a bit messy, because it's deliberately broad. So you've got the same or similar trade. So it's defined as the individual carrying on a trade that is identical or similar to that carried on by the company or by an effective 51% of the company. The individual becomes a partner in a partnership that carries on such a trade. The individual or someone connected with the individual is a participator with a 5% shareholding and 5% of the voting rights in a company that either carries on such a trade or is connected with such a company, or the individual is involved with carrying on of such a trade by somebody connected with them. So it all there talks about trade, but it does also talk about similar activity. So the kind of things that could catch you is, let's say you ran restaurants. So you were a restaurateur, you had a company, you ran loads of restaurants. You got fed up with that, decided, you know what, we're finished with that. You sell them all out of the company. You have your cash in the company, you liquidate and you take your money out. And let's assume there were the days before we had a very small limit and you were able to pay your 10% tax. You're then sitting with your cash. So what do you do with your cash? You've no intentions of going back into the restaurant business again. However, you see there's a property which has come up, a good investment property. It's a restaurant, but that's okay because you're not going to run it. So you invest into this restaurant and you receive rental income from whoever runs the restaurant or owns the restaurant. Is that the same or a similar activity? Well, according to the revenue, that is a similar activity, because although you used to run a restaurant and now you rent a restaurant to someone, it's still got the word restaurant. So therefore, they're fairly similar. If you've somebody who is an accountant and then decides, do you know what, this is too much, I'm going to bail out. And then a year later, they decide to just focus on bookkeeping and doing nothing else. Well, that's a similar activity. You might not be doing all the lovely tax planning and everything you did before, but you're still in sort of doing something that relates to something related to accounts. And that's the kind of things the revenue are looking at. So what the revenue have said is these trigger events are deliberately broad to try and catch as many people as possible. So in the majority of cases you look at, if you're going to have a trigger event, then that's what's going to catch you. And then what you need to see is, well, if I can get into condition D, then if I can get out of that, then I won't be caught. So condition D is that tax avoidance motive. So this one's more complicated because it's a reasonable assumption that the main purpose, or one of the main purposes of the winding up, or arrangements of which the winding up forms part of, is the avoidance or reduction of charge to income tax. Well, if you have a company full of cash, and instead of taking the cash out as a dividend, you wind up the company, well, does that get you into condition D, and are you caught? Well, the revenue quite kindly have said, if you are in that situation, you have cash in a company, and you decide not to pay a dividend and instead to liquidate, they don't see that as tax avoidance. So what they're looking at is, well, what was your reason for the liquidation in the first place? So the starting point is the individual who's doing the winding up, or the person whose company it is. They have to sit there and look, making a reasonable assumption as to what their purpose is in doing the winding up. So what they need to be able to demonstrate is that they didn't have a tax avoidance motive, ignoring the pre-dividend part, but they didn't have a tax avoidance motive in entering into the liquidation. And they need to self-assess on that basis. And then it'll be interesting to see how HMRC are going to try and challenge these, because what HMRC have said is that they will challenge them using the Phoenix rules. And the Phoenix rules are where all of this started. So where somebody had a business, closed it down, and opened up the same one next day, haven't taken all their cash out. So that's the kind of cases they're looking at. So if you have clients who are doing something like, let's say, property development, loads of them, SPVs. So they do a property development, A and B do one together. They finish the development, they close up the company, liquidate it. Within 2 years, B then goes off and he does another property development with somebody else. Well, do you have to go back and amend his self-assessment return because you claimed capital gain? Do you now assess you're within the TAR because he's now gone and done another property development? Well, I would say no. not unless the main reason for winding up the first company was to avoid using it to avoid using those funds within that company to do the next property development. However, property developers will always use separate companies. They've done it for years, even when it was more expensive to do it, because there's commercial drivers for it. There's commercial reasons why you would do that. So I think there's strong arguments that it wouldn't apply. What about the situation where you have somebody who set up a company on their own to provide services into an entity? They happen to meet someone there who's also running a company providing similar services into the same entity. They decide, why are we both doing this separately? Why don't we both get rid of our companies and set up in partnership together? So what about that case? So they both liquidate their companies, take their cash and go into partnership together. Well, I think I'd be quite bullish on that one. Although they're still providing the same kinds of services, they've gone in as a different business structure. Instead of being sole individuals, they've gone in together, they've created a business, they've thought about it. So again, I think there's strong commercial reasons as to why you would do that. So I think with all of these cases, what you need to be doing is documenting the evidence as to why you're doing things. And as long as there's a reasonable assumption that what you're doing is not for a tax avoidance motive, and who's reasonable? The man on the Clapham omnibus. But provided you can put together a strong argument as to why you're doing what you're doing, then you shouldn't be caught by the rules. If it's a pure phoenix, then you'll fall squarely into this. And I know Jonathan's looking at me, I'm going to wrap up very quickly. But just to say, Spotlight 47 in February 2019. So that's the one where HMRC said that we hear people are selling their companies to other companies for cash, and then those other companies are keeping those companies or extracting the money from them, and we think that the TAR should apply in these circumstances. Well, I think the point they missed in all of this is actually there is no liquidation. So unless there is a liquidation, they can't apply the TAR. They might be able to apply the general anti-avoidance rule, and they would have to seek to do that separately. So what I would say is, look carefully at Spotlight 47. Just because HMRC have said if you sell for cash, then you could be caught by the TAR. If you've got a genuine third-party sale, you're not going to be caught. If you're selling to somebody who's buying your company for cash, what they do with the company afterwards, well, it depends whether it's any kind of a tax scheme. If it's just somebody buying up companies, I think HMRC will seek to go down the GAR rule if it's going to be successful for them. Very quickly, Jonathan, I'll do just the quick takeaways. Just worth remembering, financing a business, it's very easy to give your money away, but how are you going to get it back? And if you don't get it back, how are you going to get some form of tax relief for it? Dividend and salary waivers, they're still very good, but they need to be done correctly, and they need to be done in advance of receiving the money. Tax symmetry is a myth, doesn't exist. Succession planning is never too early to develop a plan, and the TAR and liquidations, just be prepared and support any decisions with evidence. So keep a file of evidence, because these kind of inquiries won't be around for the next few years. So you are going to have forgotten what happened, the conversations that were had, so document it at the time. Right, questions?
Thank you, Paula. You've covered a lot. Thank you very much indeed. I'll start with this one. In terms of irrecoverable loans, how would you deal with a transaction when there is an intercompany loan between two trading companies and the loan cannot be paid back?
Okay, it would depend on the kind of loan it is. So it sounds like it would, if it's between two trading companies, it sounds like it's that connected party loan. It's likely to fall within the loan relationship rules. And if it falls within the loan relationship rules, then if the loan is written off or forgiven between the parties, then it shouldn't be taxable in the party who receives the forgiveness. And for the person who forgives the loan, they won't get any tax deduction. So you should get your tax symmetry there if it's within the loan relationship rules. So if the companies are controlled by the same person.
Okay, right, thank you. Going back to the comment or the question I asked earlier, but with a bit of clarification, what was wanting to be said, or what should have been said, rather than tax options, it was share options, wouldn't they? but does this qualify for EIS?
Right. Share options, well, do they qualify for EIS? Well, under share options, you still subscribe for shares when you exercise the share options. I've never seen them being used for EIS relief, but it would qualify as a subscription of shares. The difficulty with using options to finance a company is that you're not actually putting the money in until such time as you exercise those options. So you don't get the money into the company, but once you exercise the options, then you do subscribe for shares. Whether or not you'd get EIS would depend on the circumstances at the time the options are exercised.
Okay, right. Thank you for that. You'd also mentioned, or you'd given an opinion earlier on about, I think, benefits in kind in Australia, and how you're seeing those dealt with.
Benefits.
Compared to the UK. The question was, were there any other areas of taxation that the UK could learn from the Australian system from? That's probably a very long-winded question, and I apologise.
No, but it is long-winded, but there is one thing that I keep reading, and I just think, why doesn't the UK do this? So we have loans to participators. You get hit with this 455 charge, and it's quite a penal charge. So in Australia, what they do is everyone borrows from the private company. And within the rules, it says that if you haven't repaid it, I think it's within 2 years or something, then the loan is spread over 7 years. And it's drip fed in almost like a dividend into your tax return. So you have 7 years to repay the loan before you get hit with a penal charge. So what most private companies do is they borrow the money and they keep it out 7 years, and then provided they repay part of it, then they can keep recycling that. So that's that I think is more favorable. They see it as really penal over here, and I'm going, no, we've got 455. Honestly, it's not penal. The other thing, which is, I don't know whether it's something the UK could learn from, it's unusual. A lot of businesses, family businesses in Australia, trade through trusts. So they use the trust as their trading vehicle. And the reason they do this is it's still taxed as if it was a company, but there's more flexibility as to how you can put money out to individuals, because you can have a class of beneficiaries, so you can decide who gets the income in any particular year. And it can be quite beneficial then if you've got some losses and you want to direct some losses to any particular person. But it's just highly unusual, the idea of trading through trusts. In the UK, most of us hate trusts anyway. And they're typically only used for wealthy families, or you have trusts which are set up on death.
Understood. Okay, thank you. I've got one more. How about if a director gives a loan to a company to start a business? How do we treat this question? Can the director take back the money without any tax implications?
Yeah, so a director can just put the money in as a director's loan to the company, and they can decide whether or not they're going to charge interest on it. If they borrowed the money to put in, they might want to charge interest on it, because they'd be able to get interest relief then. So they're paying the bank interest, and then they'd be able to offset the interest. And then once the company has funds, they can take that money back. It's their money to take back. Whereas if they put it in a share capital, they wouldn't be able to get their money back because it'd be capitalized in the company. So if they're confident they're going to get it back, and it's intended to be short term, then you'd go down the route of doing a loan. I would say draw up some kind of a loan agreement as well, just in case. I don't know whether there's other shareholders in the business, but sometimes directors get very involved with businesses that they don't control from a share point of view. And then when everyone falls out, it's hard to demonstrate what they actually put into the business.
Okay, thank you for that. Thank you. Paula, I'll bring us to a close, because you've kindly brought us in on time. As I say, you've covered a lot, and thank you for the presentation you've given, for the questions that you've answered. We'll let you get back to your evening
Thank you.
time. Thank you very much indeed. Stay safe and keep well, you and the family.
Okay.